Chapter 7 in the book starts to get into the actual kind of nuts and bolts of the agent's role in the buyer's financing process. And like we talked about early on, I'll say early on, about a week or so ago, this course is intended to help you understand by which a mortgage company or a bank qualifies the buyer to buy a home. I know a lot of people, a lot of the consumers out there, you financed an automobile, you financed a car, maybe you went to borrow money to buy a boat or get a personal loan at the credit union or something. And it was always kind of a mystery on how the bank makes its lending decision. Well, this chapter in the book kind of goes into how that happens, and the kind of the outline of the chapter on page 175 kind of gives you a rundown from a buyer's agent perspective in assessing the buyer's circumstances. What is their job, how long have they been on their job, choosing a lender, the costs that are involved in connection with borrowing money to buy a house, evaluating financing options, and so on and so forth. So let's go ahead and get into this chapter. You're going to need to really read through this chapter. These short videos are not meant to be a substitute for you actually reading through the chapter. But let's say, for example, a buyer calls your office, or you have a friend that says, "Hey, I think I might want to maybe start looking for a house." The first step in that process needs to be getting them pre-approved or pre-qualified. In other words, get them into the bank or the mortgage company. Let the mortgage company review their financial data, and let's kind of, for everybody's sake, let the buyer see kind of where they are financially. The mortgage company can run through their income, can run through their debt, their credit history, pull their credit reports, and just basically take a really, really good look at where they stand financially. Shopping for a loan, of course, this process is going to be kind of market sensitive. In the Abilene market, in this market, we primarily deal with FHA loans. The FHA was created for the masses, mortgage lending on a large scale, and it requires the least amount of money down. So for your cash short buyers, it works really well. It's really the most forgiving in regard to looking at people's credit history and things like that. There's a chapter specifically on each major type loan a little further in the book. There's a chapter on FHA, a chapter on VA, and a chapter on conventional financing, and one on seller financing. But shopping for a loan, as you kind of get into real estate, into the real estate business, you're going to have experiences with different lenders, with your buyers. There are going to be lenders that maybe do a little bit more efficient job in the process than others. It won't take you long to figure out really who the highly qualified lenders are in town versus those that maybe aren't as qualified. And that goes for any area, any market you decide to work in, not just Abilene. You could go to Fort Worth or San Antonio or Houston or wherever. But on page 177, there is some information there on the differences between pre-approval and pre-qualification. If you're out on a Saturday afternoon or a Sunday afternoon at an open house, and you have a customer that comes in and says, wants to look at the house, it's like, well, basically, we don't know how much we can afford. We don't know how much we qualify for. A good rule of thumb on FHA loans is that no more than 41% of their gross monthly income can be allocated to pay their housing expense, which is principal, interest, taxes, and insurance, and all the rest of their debt. So, for example, if you had a customer that made $5,000 a month gross, no more than $2,050 a month out of that $5,000 can go towards their house payment and all their other monthly recurring debt over 10 months. So you don't count car insurance, you don't count electricity bills, you don't count gas bills, you count credit card debt, child support, long-term debt, car payments, things of that nature that would calculate into that $2,050. So if you had a customer that had $1,000 a month in recurring debt, car payment, credit card, maybe a child support, maybe a personal loan or something like that, then they could basically spend $1,025 a month for house payment. So basically you have $2,050 a month to work with, depending on how much debt that customer carries. And that's a kind of a good rule of thumb, a quick, easy calculation to make for somebody. However, we are not in the mortgage business. The real estate, as a real estate person, we're not mortgage people. So it's very important that you qualify everything you say to that customer in regard to, well, I can do kind of a quick, easy calculation that'll kind of give you a ballpark, but by no means am I the authority on the mortgage business. On page 180, 181, it talks about choosing a lender, your buyer doing research. Of course, we're going to be able to help them through that process also. On page 183, in that sidebar, it talks about the origination fees. The origination fee, 1 point or 1%, a loan origination fee would be 1% of the loan amount. So if you had a customer that was borrowing $100,000 on a $110,000 house, the loan origination fee is going to be $1,000. That goes right to the lender to cover their overhead and their salaries and things like that. 184, 185 goes into the different amounts of loan origination fees, comparing loan cost on 187. On page 188, 189, there's a chart on page 189 that tries to help you understand what annual percentage rates are, APR, in comparison to the effective interest rate that a borrower would borrow on a house. 192, 193, applying for a loan. This kind of takes you through the process. 193 talks about the loan forms, the type of forms your customer is going to see at loan application. 195, 196, 197 through 199 is the Fannie Mae it is formed the 1003 loan application form. These loan application forms are federal. They're nationwide. They're used across the whole country. That's kind of a general form. And then page 200, 201 goes into the assets and liabilities, the income and monthly housing expense, details of the transaction, things like that. 203 is locking in the interest rate, and there's maybe a test question about what interest rate lock-in is, and it's simply when the buyer goes in, sits down with the bank, makes a loan application, the buyer is going to sign a lock letter probably the day of loan application. That way, if the lender is quoting a 4% interest rate today, June the 10th, then if that buyer's comfortable with that, then hey, we're going to lock that rate in and make sure that on the day of closing, that probably 30 days later, that this rate is going to be 4%. That's simply what a lock letter is. On 202, you might want to keep this around. This is what you can give your customers, give your buyers. You could even make this part of a package, maybe at an open house, loan application checklist. These are all the documents that a customer would need to make a loan application. And then on page 205, 206, 207, it talks about the actual decision process, the underwriting process. So when your buyer makes loan application, the loan officer is going to package up the loan file, and they're going to send that to their loan underwriter. The loan underwriter simply goes through a checklist, goes through the package, the loan package, just to make sure that all the documents are there, that all the details are there. Because remember, the bank or the mortgage company, they are making sure this loan meets all the requirements to be sold on the secondary market. So all the documents from the buyer have to be there. So page 210, 211 is kind of the wrap up, the outline. Take a look at the key terms on 213, and then of course take your chapter quiz just for your own benefit. It's really a good help. So anyway, we'll get chapter 8 up here shortly. Thank you.